the number one thing you got to focus on to make sure you don't overpay for a stock. Now, over the past two videos, I've discussed the income statement and the cash flow and the balance sheet with you guys, where I explained that the income statement tells us what the financial performance of the company has been over the past, right, or historically, while the balance sheet tells us the financial position of the company at a specific point in time. In other words, how much assets does the company have, how much liabilities, and how much equity, right, is there on the balance sheet. That's what the balance sheet talks about. Now, in this video, I'm going to talk about the cash flow statement, which is, in my opinion, one of the most important, if not the most important, financial statement of a company, right? So, what is the cash flow statement? The cash flow statement is, simply put, tells us how much cash is coming in and going out of the business. Okay, so why is it important? Because the cash flow statement is important because it tells us how much to pay for a specific stock. And I know this is going to sound strange to those of you who are just new to stock investing, but just hear me out. Before I get into that, I'm going to explain a few things about the cash flow statement. That is, the cash flow statement is bifurcated into three major sections. The first of these is the cash flow from operations. The second is cash from investing, and third is cash flow from financing. Cash flow from operations is basically the cash generated by the business from its core operations. Okay, the core operations, for example, meaning that, for example, we are looking at a cement manufacturer, and so the core operations of the business, is basically manufacturing and selling cement. The one way to remember the core operations of business is what is the main reason for the existence of that business. And so, like I mentioned, like I gave the example of a coal manufacturer, let's say, then the purpose of that company is to produce and market and sell coal for profits, right? So that is your cash flow operations. Then we have cash flow from investing. Cash from investing is basically the cash that is coming in and going out of the company due to investing activities. For investing activities would include things like buying and selling of assets, hard assets, for example, plant, equipment, machinery and equipment, vehicles, things like that, right? And there are a few other things, but I want to keep things simple for now, right? So I'm not going to go into too much detail with that. And of course, then there is cash flow from financing. Cash flow from financing is basically all the cash coming in and going out of the company due to financing activities. Financing activities includes things like issuing shares, payment of dividends, issuing debt, right? Things like that. And so that is what the cash flow from financing is all about. Now we come to the part where I will explain to you guys what do you have to focus on, or what do I focus on when I'm looking at the cash flow statement. Now, the two most important things on the cash flow statement that I like to look at are the cash from operations and the capital expenditures. The cash from operations are, of course, a separate bifurcation or category on the financial statement, which I just explained, right? It's one of the three major categories, and it's in fact the first category on the on the cash flow statement, which you will see on any company's financials on the cash flow statement. And so that's the first one. The second is capital expenditure. Capital expenditure is simply and more specifically, maintenance capital expenditure. Maintenance capital expenditure is basically the capex, as it's also called, is basically the cash that the company has spent in order to maintain its current level of operations. Okay, right. So, for example, if we talk about a coal manufacturer, all the cash that the company spends in order to maintain its equipment, its machinery, for example, would come under capital expenditure, right? And in the case of a manufacturer, the expenditure that the company needs to spend in order to maintain the plant, let's say the manufacturing plant, to maintain the current level of operations. Does not include growth. Okay, but again, that's a final nuance. We're not going to go into that right now. So these are the two things I like to focus on. That is the cash flow from operation and the cash flow and the capital expenditure. Now, how do we use this, right? How do we use these two line items? The way I use this is basically I'm going to take the cash flow from operations, and from that I will subtract the capital expenditure or the maintenance capital expenditure, and that will give us your what is called free cash flow. Okay, free cash flow. Remember, free cash flow is the cash that the owners of the business or the shareholders can it belongs that the cash which belongs to the shareholders of the company. Okay, and the company and the shareholders, they can choose to do whatever they want with it. For example, they can use it to pay down debt. They can reinvest into the business for future growth. They can also pay dividends with it, right? And so these are the major things they can do with it, right? So basically the cash which belongs to the shareholders of the company, right? And they have discretion over it however they wish to use it. Now, what I'd like to do is I like to see, for example, if a company is generating, let's say, $2 in free cash flow per share, right? And the share price is, let's say, $20. So this means that if I buy the stock for $20, I will be able to recoup my investment or recover my investment in about 10 years, right? That makes sense, right? Because the share is $20 on a per share basis, and it's generating $2 per share. So I'm going to take 20 and divide by 2. I get 10, right? So 10 years to recover my investment. Now, the smaller the number, the better. Okay. And also, please note that this is an oversimplification, because remember, we also need to look at things like how much the cash flow is growing. But right, but we're not going to get into that. If you're interested in doing that, then comment in the comment section below, and I'll drop in another video explaining to you guys what to do if there is growth, in how to calculate the growth, and what to do if there is growth, right? But a long story short, if the free cash flows are growing at a very high rate, then that means that you're going to be able to recoup your investment in a shorter amount of time, right? So the higher the free cash flow number, the better, right? So that's basically what this video was all about. I hope you guys found this to be of value. Before I end the video, I'd like to point out, if you're interested in more content like this, then follow and subscribe, right? And one more thing, comment in the comment section below and let me know what are your other concerns, or what are the issues you face as a beginner stock investor, right? So, and I'll be happy to share my experience with it. Please remember, I've been doing this for a long time. I've been studying and investing in stocks for almost 20 years now, and you guys just might be able to find something of value in my content. But anyway, that's it for now. I'll see you guys in the next one. Take care. Bye for now.